Hello, everyone. My guest today is Gary Saranvarta. He's one of North America's preeminent authorities on artificial intelligence. He has over 25 years experience working with leading global corporations to deliver revenue and profit growth. He founded Daisy Intelligence in 2003, bringing autonomous machine intelligence to clients in retail, insurance, and healthcare. All right, Gary, are you ready to take us to the top?
Absolutely.
All right, so you were maybe a couple years even before your time. Tell us about Daisy Intel. What's the company do and how do you make money? What's the business model?
Well, we help companies make smarter decisions, operating decisions that impact profitability. So in retail, every week merchants have to decide what products they should promote, what prices they should charge, how much inventory they should allocate. And Daisy delivers those decisions to business users, no data scientist required. And the merchants can execute Daisy's recommendations, or they can edit them and change them a little bit. And if they execute our recommendations, we've been able to double their net income, which is massive and unheard of. And that's really the power of machine intelligence.
Mm-hmm. Now, what got you into this? 2003, did you just quit your corporate job and said, I want to launch a startup? Or where was your head at?
Well, my background is in aerospace engineering, and when I got exposed to the business world, I was really shocked at how little math and science was used in business. And when I was younger, I thought all these big corporations must really have their act together and be super awesome, and they're great businesses. I don't want to denigrate them, but not math and science wasn't being used. So I kind of took my math skills from aerospace, brought them to business. I ran IBM Canada's data mining practice and was one of their go-to global people, and was using neural nets and machine learning in the 90s, all the stuff that's in vogue today. So then I realized that I thought I could do it better, had this vision of autonomous, where I think, our vision is to solve problems that are beyond human capability, that are very mathematical, require lots of data, are highly repetitive, millions of decisions a day. It's a perfect problem for machines. And that was the motivation. And really the goal was to minimize poverty. That's the mission statement. If we make a retailer more efficient and more profitable, they won't bank the money. They'll invest it in lowering prices. And in insurance and banking, if we eliminate fraud, we'll lower the cost of insurance and banking. And so if we lower the cost of services in every industry, then that means the cost of living goes down for consumers. And that was really my vision, really to fulfill the promise of the information age.
With the big assumption that you're competing in markets which will essentially, the management teams will always drive those price savings back through to consumers. You're assuming this is a market that is in a price war.
Yeah, I think in the most companies will, because that's how you gain market share. And I think in retail, which is 50% of world GDP, it's an industry that's really driven by price, and price drives market share. So I think in that industry it works. And I think in general the cost of everything is getting to the level where they have to cut costs, because consumers just can't afford to keep paying increased insurance premiums and more banking fees, and efficiency has to be found somewhere, and I think we've gotten close to the limit. Our incomes haven't kept pace with the cost of all of these services.
Mm-hmm. Give me a sense of the business model. What's an average customer pay you maybe per year? I'm sure you have a ton of different variants, but on average.
On average, they're paying $250,000 to $500,000 a year, in that range, and it's a monthly fee. And for us, if we don't deliver 10 times that return, we tell our customers we're going to quit and move on, because we're really selling net income growth is what Daisy sells, and we've been able to do that so far with all of our customers.
Yep. So if someone's paying you $500,000 per year, or actually let's do your lower end, $250,000 per year, or about $20,000 a month, what do you need to look at when you're signing them up as a customer, and how much gross merchandising value do they need to be doing for you to know that there's room to shave off $250,000 worth of cost savings?
Well, we've been able to get a minimum of 3% top line sales. So if you're a $100 million company, that means we're helping you generate $3 million in new sales, of which 2/3 is cost of goods sold. So we would drive $1 million to the bottom line in that case. So $1 million there, we're getting paid $250. That would be the kind of low end of ROI. So typically we're working in companies at the small end that are 100 million, and most of our clients are kind of in the billion, $2 billion range. And then we have some really large clients who are in the $10 billion plus range.
The retail kind of margin, gross net margin, you just assumed it sounded like 20 or 30%. Is that fairly standard?
Well, the gross margin in grocery is typically, kind of a third, I would say 35%.
Gross margin. Got it.
Yeah, gross margin. Net margin in grocery is,
very
the
little.
mid-market guys are, less than 1%.
Yeah.
And, maybe the big general merch guys are, a really good one is, 3%, right? So that's why one of the reasons I chose retail, because I felt, doing something 1% better doesn't sound like a lot, but if you can achieve that in retail, it has a massive impact. Right?
That's right. Okay, so let's put this all on a timeline. Again, what year did you launch it in?
I launched in 2003.
Okay, 2003, and you were just leaving IBM at that point?
I left IBM in 2003 and I founded Daisy. Yep.
Okay, and what have you scaled to today in terms of total customers on the platform?
Total customers, we have a total of 17 customers today.
Yep, and these are very very high touch kind of customers because of what they're paying you.
Yeah, we have Canadian customers in Canada, United States, one in New Zealand, and one in Europe. So there's a global need for a product. We have a lot of sales opportunities in Latin America as well. So there's a need for the product. We're raising capital to try to scale the company. We believe we have something that's secret sauce that applies everywhere. We're the only company using reinforcement learning in outside of engineering, and that really delivers huge value.
Gary, you're considering a raise. What general kind of range are you at today in terms of monthly recurring revenue?
Yeah, we're kind of at 4 million in ARR, and so we're kind of right at the threshold of where a lot of the kind of VCs, large VCs, Series A, we're looking kind of at a 10 million plus raise. The more, the better. I think 10 million goes quickly. It allows us maybe to scale to one global market and to invest more in our kind of fintech offering, which we've kind of been very opportunistic about to date. And we envision then to do a Series B to grow the scale of the company beyond outside to other markets. So we're thinking kind of either Europe, Asia, Latin America, and if we find a partner who's willing to put in more, then we'd go to more markets at once. So
assume a $10 million raise. What valuation in an ideal? I know you're probably still negotiating this, but in an ideal world, what would you like to raise at?
The valuation is a tough thing. I think our IP is a lot more valuable. The VCs, there's a lot of different types of investments going out there. We've seen companies pre-revenue raise 100 million, and so I'm not sure if you look at an IP valuation, I'd say we're more than 100 million in value. If you're looking at purely financial metrics like typical SaaS companies, then we're maybe 30 to 40 million in value today.
Yeah. So if you got a term sheet for someone saying, "Hey, Gary, we'll give you $10 million. It'll be a $40 million pre-money valuation. You're selling us 20% of the company, essentially." Is that a deal you'd look at?
Yeah, absolutely. I mean, we want partners who can help us scale. I think the money's great, and then we just want folks who've got experience scaling and can help us network into the industries we sell into. But for sure, those are the deals we're looking for today and having some early conversations.
And bootstrap today?
No, we did a kind of angel raise, super angel raise. We've raised about 4.5 million since 2016. We sold off a professional services business that we used to build all the IP.
Yep. And
then we became 100% kind of recurring revenue in 2016. Since then, we raised with a couple of significant super angels about $4.5 million in so far. And we have venture debt, a company called Espresso Capital in Toronto, who's been a fantastic partner. Has you have a venture debt facility with them that is based on MRR.
And the payment back on that as a percentage of monthly MRR, or it's a term loan with fixed interest rate?
It's a term loan with a fixed interest rate as we draw down, and then they've been rolling over the terms as we get larger and larger. They've been very supportive, so it gives us it's expensive capital, but it gives us non-dilutive capital and gives us flexibility to negotiate with VCs who we're not running out of money as we're having these conversations.
Now you've positioned yourself extremely intelligently. Talk to me about growth. If you're doing 4 million today, what were you doing about a year ago in terms of run rate?
We grew 100% in the last year, so we've done kind of basically triple, and it'll be close to a double by the end of this year. So and we're really chicken and the egg. Now we need capital to keep the growth rate. As we get larger and larger, it's hard to maintain that pace. But for us, if we raise the 10 million before the year end, then we'll see the growth kick in the back half of 2019. So we'd expect to do a double next year and then back to another year of triple. That's kind of what our model is. We envision if we get to about 50 to 60 customers, we think we'll be in the close to $1 billion valuation, and we're already at kind of 17 today. So it doesn't seem like a stretch that over the next 3 years we can get to that kind of unicorn valuation.
What's your team size today?
We're currently 40 people with kind of 12 open positions. So, growing fast, and we want to invest in the team. We've got a great team who's been working very hard, and we want to kind of give them some more support to help them as we continue to add more customers.
And where's everyone based?
We're all based in Toronto. We have an offshore team in the Ukraine. We have 4 people there who kind of help us because we got our customers are in many different time zones, especially with New Zealand. So trying to cover the 24-hour clock. But 90% of the company is based here in Toronto. We have one salesperson in the U.S. that we just hired, our first U.S. Sales guy who's based out of North Carolina.
That's great. Talk to me about churn. So obviously churn's critical in this kind of business. What's your revenue churn been over the past year?
Our revenue churn is negative. So, we've been growing. We've lost a few customers. The big challenge for us is change management. We're flying right into the face of human machine interaction. So some merchants don't want to have us stepping on their toes and telling them what to promote and what prices to charge. That's their job today. So in the companies where we haven't achieved that change, we've lost a few early clients. But overall, our clients have been paying more. We typically give them a discount in the first year to account for the ramp up time, and the second year the fees go up. So from the revenue perspective, it's negative churn. Although
how negative, Gary?
We've grown. I mean, our revenue has grown. Kind of negative 10% is what I'd say. Even though we lost kind of 2 or 3 customers. Right?
So Gary, I want to peel that onion back for a second. So that means customers you signed up a year ago. Today, maybe you lost 3 customers, which were making up 5-10% of revenue?
Yeah, something like that. And then the remaining customers, we grew their revenue by kind of 20%.
Exactly.
Right? And that's so. And we have multiple modules we sell. So some customers, our contract meant they were paying more in the second year, and then some of them also added additional products.
Yep. No, that's healthy. 110% net revenue retention is great. And then what are you spending to acquire these customers, fully weighted?
Our CAC ratio is kind of 2.5, and I think we can improve that.
Sorry, ratio to what?
The cost of acquisition, the customer cost of acquisition over annual contract value. So our annual contract value is 2.5 times kind of customer acquisition cost.
Oh, that's good.
Right? So
your payback period is what, like 4 months, basically?
Yeah.
Yeah, that's healthy. So 4, and then I think you said people are paying basically about $20,000 a month. So what is it? You're spending, you're happy to spend $80,000 to get a $200,000 customer.
Yeah, and our sell cycle is kind of 6 to 12 months. It depends. The larger customers take longer. The smaller ones go fairly quick. We sell to the C-level, so the sales happens reasonably quickly. Retail is not the fastest moving industry, but when you talk to the C-level people, they decide pretty quickly whether they want to work with you or not. So that helps.
That's great, Gary. Let's wrap up here with the famous 5. Number 1, what's your favorite business book?
My favorite business book is Built to Last, a Harvard business book that talks about some great companies and cultures. And that's a great book. Number
2, is there a CEO you're following or studying right now?
Not particularly. I mean, I've been kind of smoking my own fumes, but I mean, I like some of the guys like Tim Cook seems to be a really, really great guy. And I take good things from everybody. I mean, a lot of CEOs, a lot of smart people out there have a lot of great little philosophies. So, I listen to all the popular ones that people are following and take a tidbit from everybody.
Number 3, what's your favorite online tool for building your business?
My favorite online tool. I think Salesforce is a great tool that we use for kind of customer management and customer contact. So I would say Salesforce.
That's great. Number 4, how many hours of sleep do you get every night?
Oh God, 4 hours maybe.
Gary, how are you living?
It's brutal. Yeah, it goes up and down, but on average, I would say the last month has been about 4 hours a night. Get up and go to the gym in the morning.
And what's your situation? Married, single, kiddos?
I'm married, have 3 kids. It's a second marriage, but they have 3 grown-up children one's finished university, 2 in second-year university.
That's great. And how old are you?
I'm 52 years old.
52 years young, Gary. Last question. Yes. What do you wish your 20-year-old self knew?
I wish I had started a business 15 years earlier. So I think I wish I knew more about corporate finance and a little bit more about human psychology. With an engineering degree, it's very focused on technical and math, but I think more financial knowledge and more human psychology knowledge would have been great.
Guys, start a company earlier, more management, more business knowledge coming from Gary. Seems to be doing fairly well though. Left IBM in 2003. Today, team of 40 people building Daisy Intelligence, really helping retail brands and other brands unlock revenue. They've got 17 enterprise customers paying on average, call it 20 grand per month, just past a $4 million run rate. That's up double from a year ago. So about 100% year over year growth. They've raised $4.5 million. They're churning about 10% of revenue. That's on a gross basis each year, but they're expanding that same cohort 20%. So net revenue retention of 110% year over year, spending up to 4 months of first year ACV on acquisition with their team of 40 people between Toronto and Ukraine, currently looking to raise $10 million, hopefully north of a $40 million pre-money evaluation. Gary, thank you for taking us to the top.
I appreciate it. Thanks for your time.